Hey everyone, hopefully you're having a good day. My name's Andy. My channel is Finding Value. Today we're going to go in, look at Twitter. We're going to look at a bunch of different things that are financial topics, commodities, and anything that's dealing with wealth building. I'm going to interject my financial opinions and we're going to dive right into it, talking about all of these different things. So if you want to follow me, it's at finding_finance, and you can also join our community at finding-value.com, where we do midweek updates, question and answer sessions, and other information that I post on the website. So let's start out with want to see the most important chart in all of investing. It says, here's why it's time to short big tech. And this is kind of cool because it's the top 10 companies by market cap for these different decades. And what you'll notice is that they just rotate. So you'll see IBM, AT&T, and you see Exxon, Standard Oil, Schlumberger, Shell, Mobil. These are all at the end of the bull market for commodities. And you can see a lot of the top companies are natural resource companies. 1990, it started to become more tech in these two areas here because tech rose up and the commodity bull market was in its down leg. So we have NTT, Bank of Tokyo, Industrial Bank of Japan, Sumitomo, Toyota Motors. These are all Japanese companies here. 2000, it was the technology bubble. So it's going to be a lot of tech companies: Microsoft, General Electric, Cisco, Walmart, Intel, NTT, ExxonMobil still hanging around, Lucent Technologies, Pfizer. In 2010, that was at the peak, more towards the peak of the commodity bull market, and technology stocks were down. So it's ExxonMobil, PetroChina, Apple, BHP Billiton, that's a base metals producer, Microsoft, ICBC, Petrobras, China Construction Bank, Shell, and Nestle. 2020, what do you think this is going to be? We are at the top of a technology bubble. Apple, Saudi Aramco, Microsoft, Alphabet, which is Google, Amazon, Tesla, Berkshire Hathaway, Meta, Alibaba, and Tencent. So I do think that we're going to see a vast rotation of money. And in 2030, if I were to kind of guess, I think you're going to see a lot of natural resource companies kind of work their way up into the top 10 companies by market cap. But they have a long, 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 long way to go. A lot of these companies over here are now trillion, multi-trillion dollar market caps. And that is scary because a lot of the natural resource companies, they can go up many-fold for them to become that large, which means what the products they're going to sell, they're going to go up many-fold. At least that's my opinion. Jesse says there's a large portion of the population that doesn't care real estate is the most unaffordable it's ever been. They're buying anyways, and they'll skip vacations, live with extended family, and work 12-hour days to make it happen. Well, yeah, I would say the majority. This is my take, and this is what I've heard from a lot of people is, the females in a relationship who are going to have kids, they're gonna be like, I don't care how affordable a house is, we're going to go buy one. And that, right, wrong, or indifferent, I'm not saying that's necessarily the wrong take on it, but if you start having kids and you've got a large mismatch in demand and supply, affordability doesn't matter. And I'm just going to say this: females will go after people who can make money that can buy homes. Period. If they want to have kids or multiple kids, and it's not like, oh, hold on a second, we're going to wait a decade for the affordability to become better. It's just not going to work that way, guys. And I've seen other people talk about it. They'll say, well, unemployment's not going to fix this situation. It's a supply demand situation. And we've seen the supply demand situation get out of whack with large demographics come into home buying years and seen unemployment go up at the same time. It is demand and supply driven. Unemployment may not solve that supply demand situation. So it's not if the demand is so much greater than the supply and you've got unemployment along with it, it's got to kill enough demand to actually matter. And I think people just kind of write it off. They read data and they just say, oh, it's just this. It's like, it's deeper than that, guys. It's not. We have to, I don't know what the exact demand supply imbalance is. I mean, it's estimated to be 6 or 7 million homes at this time, which means, you know, when we shift from a technology bubble into a natural resource housing boom, we are going to see job losses and unemployment in certain sectors as the economy has to basically reshift. And it's not going to do it overnight. So we're going to see job losses in technology companies for a period of time. And not just tech companies, but companies that are commodity consumers. We're going to have to adjust some of those companies and they're going to have to move into and help the production of natural resources. And that's the shift that's going to occur. And it's going to happen under these market conditions where a large portion of the population doesn't care about the affordability. Or maybe they do care, they just can't do anything about it. It's out of their control. Here's Grady, says gold broke out against the SPX, silver broke out against the SPX. Also posted on the break out for platinum versus SPX months ago. Now it's most probably back testing. So platinum versus the S&P 500. We've got the falling wedge. We've broken out, doing a little bit of a retest type move, and then we'll eventually work our way higher. This is all, it's all part of that big economic shift. Another thing I want to talk about is all of these charts that I'm showing you day after day after day, they are all describing a market condition. They are all interconnected. Everything I'm looking at, everything we're seeing is interconnected. What is that interconnected thing telling us? Well, in precious metals, in natural resources, in companies that are, or countries that are natural resource rich, like the TSX, Russia, Brazil, all of those chart patterns are signaling that we are bottoming. All of them, not just one, not just two, every freaking one I pull up. That is also signaling, because of the cycle that we're in, these are signaling that a housing market boom is also coming. Because we have not seen a commodity bull market without a housing market bull market. Or you could say we haven't seen a commodity bull market without credit expansion. Credit expansion, at least the majority of it, it comes from the housing market and the loans against those houses. In 1930s, they did revalue gold, and that did revalue all of the commodities. So that did occur under a non-expansionary phase of real estate, but they did that by revaluing gold. And gold is the link of the revaluation of everything. And I'll talk about some other stuff here coming up. So this is all interlinked. It says the only things that will stop Canadian real estate are job loss, stopping immigration rates this high for 2+ years. I don't even think 1 and 2 are valid. I don't think they are necessarily valid. Well, it might be in Canada. I don't know if it'll be valid in America. Because high rates doesn't mean you will stop a housing market that is vastly out of balance. It can slow it down. I don't know if it will stop it. Because if the rates were to stop it, so let's say it slows it down and stops it, according to this, all right? So it stops it for a period of time, rates go back down, and then what happens? What happens when the rates go back down? Oh, we've got another housing bull market. So it delays it, it slows it down, it doesn't stop it. And job loss doesn't mean it will stop it either, because the imbalance is driven by the demographic. It's driven by the population. Just because you lose a job in section A doesn't mean they're going to go and get a job in section B and that they don't need a house at some point. So job loss and rates can slow it down, but they don't stop it. They just delay the move. You have to build the homes. Building the homes is what stops this. That's been my approach. Now, could we get to a balanced market where they build enough homes and the demographic starts running out and we get into a balanced market and the inventory shoots up? Yes, that's what is going to solve the problem. If you want to solve it indefinitely, that everything he put there is delay. It all depends on the demographic, in my opinion. So he says, are these stocks you would feel comfortable holding forever? Apple, AbbVie, Realty Income, Starbucks, Broadcom, the Home Depot, Bank of America, Microsoft Corp, Johnson Johnson, and Coca-Cola Company. I would choose different companies than a lot of those. I would choose Chipotle, Chick-fil-A if it was public. I would choose United Health Group or Anthem health insurance companies. I don't see an insurance company up there. I would also choose other insurance companies like MetLife or something that insures cars or something like that, Progressive, whatever it is. I would not choose Coca-Cola or any of those companies. I think eventually people will hopefully move away from drinking sugar water. It's done very well in the past. I do think companies like Johnson & Johnson and the Home Depot would be very good picks. So I agree with those. Realty Income, I don't know about that one. I know they have a lot of commercial real estate loans, or not loans, but they rent commercial real estate to a lot of companies. And then you could have a bank in there, Bank of America. I'm not sure if I choose Bank of America, but yeah, he's probably got it somewhat close. About half of the companies are good. The other half, nah, I don't know. Would you accept $1 million to never drink alcohol again? Yes, I would. I hardly ever drink any alcohol. So it says, but if you ever knowingly ingested any, you'd owe $2 million. Yeah, that's fine. I'd accept it. Give me it. I'd never drink it again. No big deal. Trading rules. It says control risk via position sizing. That's exactly what I do. Let your winners get away on you. Let your winners get away on you. Resist the urge to take profits and scale out very slowly. Yeah, that's pretty much what I do. And I let my winners run. And I've got a lot of oil and gas companies that are up quite a bit from 2020, and I'm letting them run. And in order to make copious amounts of money, you have to let your winners run. You can't cut every winner short. I know a lot of retail investors, that is what they do. They hold on to their losers, they cut their winners short. That's limiting how much money they make, vastly limiting how much money they make. Giovanni says OPEC Plus output fell by 820,000 barrels per day to a 19-month low in May. Output by OPEC members fell by 440,000. And supply by non-OPEC members was that. So it's down to deliver the cuts. Art replies, you're going to be seeing substantial physical inventory draws. That's going to push up into the low 90s for oil, according to Jeff Curry. We'll see if that happens. Hopefully it does. The same debate since March 2001 FRO presentation. Economic recession. I'm afraid of the reduced demand for oil as a function of the current recession. Here's world oil consumption from 85 to 2000. Straight higher. Even if we had recessions, it basically just went up. It says commodities and inflation. In 1922, 100 years ago, the average American home cost the same 4,400 barrels of oil. Today, the average American home costs 4,400 barrels of oil. Wow, they're using ratios to determine value. And that value hasn't changed over that period of time. You could also say that 4,400 barrels of oil is a good hedge against inflation and buying the average American home. They're all inflation hedges. So inflation is just money being created at a faster pace than all of the other things in the world. That's all it is. So according to Deutsche Bank, the U.S. housing market is underbuilt. No way. No way. Really? It's underbuilt? It got worse during the pandemic as household formations boomed far above completions. Deutsche Bank says they've gone from cautiously optimistic to decisively bullish on new residential construction. No way. Wait, these guys are coming around to where I've been since I've started the channel in 2020. Cumulative completions versus household formations. What we're looking for are a difference. So the 70, 80, right? These were the two big commodity booms, 70 and 80. We had another large commodity boom. Oh, wait, this is exactly where it is in the 2000s. And then guess what's going to happen? We've got another commodity boom that is coming. So the cumulative household formations, the blue, and you can see it's far above where the red is. The red's the cumulative completions. Other areas, this was a bubble here because your completions were far above your household formations. And what happens is your inventory goes way up. This is where your inventory went up, is on the back half of 2003-4 is where it started to take off, and we started getting more inventory. Same with this one, more inventory. More inventory at the end of it, more inventory at the end. We don't have the inventory. We have a shortage. We have a deficit. And we should be decisively bullish because of household formations growing at a faster pace than your cumulative completions. This is what's going to drive a bull market in commodities because the credit expansion. That is where I think higher interest rates are going to have to remain elevated because the market is going to force it. Powell is screwed. He can't stop this because the demographic is larger than what he can do. He can try to delay it, fine, but when interest rates go back down, it's just going to spark another big boom in the housing market in an expansionary phase of real estate. There's your proof, some of your proof, right here from Deutsche Bank. What are the best careers to reach financial independence and retire early? What I'm going to say there is anything that doesn't have a fixed salary or has a salary, but you've got a variable payout based off of performance, I would say particularly in sales. So the more you sell, the more money you can earn. You cannot have a career where you get paid a fixed amount and make a ton of money. It's very hard to do it early. So you can't be in manufacturing. You can't be a manager per se. You got to get something where you can really push that variable income. So maybe like you go into real estate, become a realtor, and you're in a very high cost area where you can make a lot of sales of very high dollar homes. That could work, where you could make a lot of money and become financially independent. And then you could also buy and sell real estate yourself and do it yourself and do either housing flips or rentals or something like that. That I could see a good area to be in to make a lot of money and retire early. There's obviously other things I think in sales that could really push the income button, because you're gonna have to get your income way up. If you want financial independence, you want to do it early. Then you could also push being a really good investor. But I think that's harder because you're going to have less control over the investment side than you do on the income side. So you really want to push what you can control, and you want to push, a business. You could start your own business. Hopefully you've got a good idea and it takes off, or you're in sales or something like that. If you're a dividend investor and own greater than 25 stocks, why not just buy an ETF? Because ETFs take money from you. They have a cost. It has an expense ratio, and that expense is eating away at your money. Why not create your own ETF? If you create your own ETF, you can control the stocks that you own in your portfolio. It's not an ETF with someone else managing it. And if you don't like the majority of the companies in the ETF, why buy it? I'm pretty picky. I like buying my own companies, and if you're going to do a dividend portfolio, I would buy a resource dividend companies, which I'm doing. I basically have what this guy is saying. I would much rather weight the companies that I want to weight differently than something that I've got in a portfolio that I don't want to weight as much. versus an ETF, and it's going to drastically have an impact on your performance of the portfolio, given the weightings that you put towards some of these companies. This is the most famous prediction of another big oil crash is probably from Cathie Wood, who compared the contemporary oil market to the last years of whale oil. As we have subsequently hit all-time high production and consumption, this has not proved out. It says, the rise in oil prices this year is a function more of supply than demand. At the turn of the 20th century, whale oil faced the same fate, and whale oil prices fluctuated dramatically. If at ARK Invest's research is correct, oil prices will suffer the same fate as whale oil prices. I don't even know what to say there, guys. I mean, I don't know what to say. I'm just going to leave it at that. I think she's going to be wrong on that. This guy says, unless you're making $85,000 a year or more as an individual, or $170,000 a year as a couple, a $700 a month car payment is a terrible idea. Do you agree? I can't name one. I can't name how it's a great idea to have a $700 a month car payment ever. Like, no matter what the income is. If you've got the money, why would you take a loan out and pay it with a $700 a month car payment? Because those loans are usually pretty short, like 5 years. And I mean, I don't even, what is that? $700 a month? Is that like an $80,000 car or something, or 70,000, something like that? And I don't know what it is with the increased interest rates, but I mean, $700 a month's quite a bit of money. My mortgage isn't even that much more than that. So I don't know. I haven't had a car payment ever. I bought my car way back in the day, and I've never had a car payment to begin with. And I will not pay interest on stuff that depreciates. You know, I'm fine doing it on a house that goes up in value or fluctuates with value to supply and demand in the market, but I'm not going to do that on appreciating, liability. I just think that's a terrible idea. So I think it's a terrible idea to do that no matter what your salary is. So that's what I've got for today, guys. Give me a thumb up for the content. Subscribe to the channel. Subscribe to the website if you guys are interested. And that's all I've got for today. So hopefully you enjoyed it. We'll catch you next time. This is Finding Value.